Okay, what's going on? It's Wednesday, 10 a.m. We're streaming live here, modeling. We're going to look at seller financing. I haven't done a ton of this logic myself. I've done one job that involved heavily doing seller financing for a mobile home park where it had an investment group. They bought these parks and then they sold them to people that they actually financed the sellers, obviously seller financing. So we're gonna try to model something here today. Let me send out the link or the tweet and stuff. Don't forget, check out smarthelping.com for all kinds of financial models. I've done over 120 now, I believe. As you know, I've been upgrading all the startup models with financial statements for the last 6 months, and I'm getting close to being done with that. So once that's done, I could do more of what I'm doing now, which is just new models. Uh, I've got all kinds of templates for my main categories are SaaS, recurring revenue, uh, real estate. Where's the real estate one? Real estate, and then I've just got a lot of industry specific models for all kinds of different things here. And then just a lot of just general helpful tools for accounting, human resources, a lot of trackers for them, personal finance, structures in Google Sheets and trackers, sales pipeline, and valuation. So you can buy templates individually, you can buy them by category bulk, or you can get them all for $9.99. Uh, Very good deal here. Lots of value. Okay, let's get going on this. So let me send the link out to Twitter. Send the link out to Twitter. Here, here we go. Okay, so we got our blank Excel sheet here that we're going to build off of, and we're going to figure out, let's just look at a general definition first. So what is seller financing? A type of real estate agreement that allows the buyer to pay the seller in installments rather than using a traditional, I'm assuming, loan. Using a traditional mortgage from a bank, credit union, or other financial institution, a seller financing agreement. So it usually involves real estate. I guess it could be other stuff, but usually it's real estate. A seller financing agreement functions along similar lines as a mortgage loan, except that it cuts out the middleman and allows the home seller to own and oversee the debt instead of a traditional lender. Obviously, also you're going to get interest revenue instead of just let's say, how do I show this? Well, let's look at a couple other things first. So if you choose to opt for a purchase money mortgage, a mortgage issued to a home buyer directly by the person, then the seller will provide financing and handle the mortgage process, during which you will enter into a mortgage with the seller instead of a corporate lender, also sometimes referred to as owner financing. We're not doing owner financing or purchase money mortgages. Seller financing's advantages include no minimum down payment, home ownership access for those with poor credit. Right, so yeah, it gives you, if you want to sell to somebody and they can't get a loan through a bank or whatever, you can just say, well, I'll take on the risk and just sell it to them. Hopefully they pay me back. uh, Now, I believe car dealerships have a lot of this going on too, but the logic I'm going to build should be pretty agnostic to the industry because it's just numbers. Seller, or I mean, it's just going to be logic. Seller financing real estate agreement. Yeah, a seller financing agreement functions along similar lines as a mortgage loan, except that it cuts out the middleman. Okay. Common types of seller financing agreements: land contract, assumable mortgage, home financing, in which buyers are given an opportunity to purchase a home by. Okay, so not doing this. This is buyers are given the opportunity to purchase a home. So you're just taking over their current mortgage. Lease or purchase, no. Land loans. This is what we're doing. The homeowner agrees to serve as a lender for the home buyer and provides a loan for the purchase, which the buyer repays, making monthly payments to the seller. The seller continues to hold the property's title until full repayment has been made. So advantages, why would you do this? So seller financing advantage for sellers, ability to save on closing costs. Sure, yeah, you're not going through the bank and all their overhead. Uh, can produce human capital gains tax savings. Yep, this is a big thing. Faster time to sale. Release from property tax. Homeowner insurance. Oh. So here in seller financing, the the seller is still paying taxes? Who's paying the property tax? Oh, you can sell the note to an investor. Advantage for buyers, great access, yeah, lower costs, yep, yep. Okay. Release from property tax. What? Oh, I see. They're saying that you, the buyer, is paying the property tax. Right, obviously. And that's okay. So disadvantages of seller financing: fewer regulations, buyers still vulnerable to foreclosure if the seller doesn't make mortgage payments to senior financing. Oh, that's interesting. So so we're saying here if I own a mortgage on this home and I sell it, this is saying I could get foreclosed on if I haven't been paying the mortgage, and then the buyer who bought it from me that's paying me mortgage could, if I'm not making my mortgage payments to the senior financing. Okay, no home inspection, high interest rates. All right, well, that's good enough. Let's get into some logic here. Um, okay, so we have purchase price. Let's just start building here. So how much am I selling? I own this house. I'm going to sell it for, let's say, I don't know, $500,000 or whatever the thing is you're selling. Okay. Now, oh, here's the other part of it. I wanted to do like margins and profits. So, um, original cost. Let's say I bought it for 300,000. Sell price 500. So there's a $200,000 gain here, but you're getting paid in installments. So we go amortization schedule. Um, we'll just do periods here. On down to whatever, doesn't matter. Let's freeze this as well. All right, and actually, we'll start at 0. We have, so I am selling this for 500,000. My cost base is 300,000. Let's look at starting balance. Here in this case, it's this. Starting balance, and then I want to put principal, interest. Now so when I did this before for a client, it was way more complicated because they were trying to, oh, it was so complicated. They were trying to say, oh, how can I remember this? I'm trying to remember. Like, honestly, I'd have to find it. Let's just look at this example here. All right. So you buy something for 300,000. You sell it for this price, and you're finding the buyer who's buying it from you is financing it. So starting balance, we want the principal payment, interest payment, and then ending balance. I guess this could be period 1 actually. Starting balance, we have to have some loan terms, obviously. So let's say, oh, APR, your interest rate, say 7%. I guess this could also be used for personal loans that you're doing. Uh, all right, APR, amortization period in years. Let's say it's a 30-year loan. And then payments per year. We'll say 12. And then first payment date. We'll put a date function in here. Let's say we're going to start paying it on July 1st, 2022. Okay, and then this is going to be e-date this, comma, and then if we, let's say we did 6, so this would be 12 divided by the payments per year. Okay, so there's your months. Now let's say this was only 2 payments a year. Perfect. We have 1, 2, 1, 2, 1, 2, or say 6 payments a year. Okay, so that's working. All right. Seller financing assumptions. Okay, so let's say just we're going to have this amortization schedule. Now there was something tricky that goes on with the principal and interest payments here. I wish I could find that other sheet. It has some cool stuff in it for it was for a mobile home park where they were doing a bunch of they needed a model for seller financing the homes. I can't remember. All right, let's just do a starting balance of principal payment. Oh, also we'll do up here summary total principal paid, total interest paid, total paid. Principal payment equals PPMT, and then we have the rate. Now, this is tricky because if we do something like 6 payments a year, then the rate is your APR divided by 6. So this is dynamic here. Interest rate charge for the period. The period number I believe we just do this. The number of periods is going to be total years times payments per year. Present value negative, and then that would be the starting sell price. Okay. Okay, let's think about this. So if you buy it for 300, you finance it, you're getting 500. Now, do we want to say if you're buying it in what would the amortization schedule be for the original cost? I don't think that's actually relevant. Man, I wish I could find this model. Let me, no, I can't pull up well, okay. Let's do interest. Interest, it might come to me as I'm building. So starting balance times the annual rate divided by payments per year. Well, we also want to do a total payment here. And then ending balance is simply starting balance minus principal payment. And this is the starting balance for the new period. So pretty simple. And you can see this goes for 30 years, and then it's paid off in month 360. Which 10 times 12, 360 months. Now, where's the first error? I guess it'd be this. So we need to put a if error in here. Then go 0. Okay, perfect. So there's just a regular amortization schedule. Now the question is, so we can say total principal repaid. The question is going to be how to make this more interesting. because there's some cool stuff you can do with this. So we'll probably do some kind of tax thing because as this so the interest is obviously interest revenue. That's all taxable. The principal, however, there's some tax between what the cost was and the price you're actually selling it for, because you're financing this amount. You only had to pay this, but you're getting this amount over time. Oh, also, these can be just, we'll do accounting for this. And then we'll put everything to the right, except for this. Okay. So just formatting. So you've got this schedule. Every time you get a principal payment, there's something with taxes against how much you're getting repaid. Obviously, we're getting 500,000 back. We only paid 300. We're also getting $697,000 of interest. We're going to want to figure out the present value of things. There's a whole bunch of stuff here. Let me look up taxes on seller financing amortization. How is seller so the amount the seller originally paid for the property. Wait, let's go in here. The concept of paying for something on an installment plan is familiar to almost everybody. Yep. Yep, installment service statement. So I'm gonna probably put this in the real estate bundle as just a generic template. Uh, Possibly in the personal finance one as well. And I was thinking about potentially scaling this out. Um, it'd be kind of like so I did a lending model where I did show where you could just enter assumptions about different loan types and it'll scale for however many loans you settle over time by month. But the issue here is it's different because if you look at the internal rate of return of this, so okay, so here's where it can get cool. Okay, let's look at the seller's cash flow. So let's assume period 0 is just the original, purchase. So they had to acquire it for that. And then we say the positive payments would be this. Let's move this up one. I format this all as currency here. Okay. So this is the monthly cash flow. You purchased it, and now you're doing seller financing. So the IRR monthly is this. 2, and then you can convert the monthly internal rate of return as a compounded value to annual with a little bit of math, and I'm going to pull up a, which one has it? This one does. I just need to go from monthly to annual. I know I have this calc right here. Okay, so this calculation. So there is a 13.84% annual internal rate of return based on, here's my cost. I'm financing this amount. I'm collecting that amount over time. Here's the rate. And there was something tricky they were doing when I was modeling this, or interesting, where they had the rate here, but then they also defined a different rate as what would drive the amortization schedule. And I think it was something to do with like, so, it was like if you charge an interest rate of X, it was something to do with like, so this is, let's say this is your investor money. They give you money to buy this, and then you sell it here, and you charge the buyers pay this to you, but then you can change this payment. Oh man, I wish I had that other. I'm gonna look up that other. If I can find it, I'm gonna look it up, and then if I stream again tomorrow, um, if I don't finish this today, or I can just stream again tomorrow if I find it before I actually finish the whole template, and we'll see. Very curious, because I can't remember exactly how it worked, but it's very interesting what was going on. Okay, so I mean, we have a really basic thing here where, okay, we have a cost, sell price, the APR amortization for this sell price. So I'm the seller, I'm collecting this from the buyer every month. I bought the cost though was 300,000 for me. I'm collecting $500,000 over time plus interest in this, and that's my internal rate of return of 13.84%. Now I guess if you think about it, you could charge what APR would you have to charge to make the IRR 7%? And that would change the payment. So for example, let's see, 10%, or I'm just, and there's a way to solve for this, I believe, but I'm just guessing, I'm just trying to get a concept out here. So let's say I charge 2.41% interest rate to, oh yes, here it is, here it is, here it is. So here's the basic concept. You're trying to figure out what is your IRR, what do your payments have to be, so and what do the terms have to be so that the IRR is a given percentage. And this is only calculable based on, you have to know what was your cost basis, and then what are you going to get paid over time. So your IRR is a given rate, and the terms are going to be based on essentially the difference. Well, the big difference is going to be your cost versus the sell price. So if this was, say, 400,000, I'm going to have to charge a higher APR. Yep, so see, now this goes down. So then to get a higher IRR, I have to go 5%, 6%, 5, 4.8. So almost double the APR almost doubled when my profit got cut in half based on my cost. So if your cost was, really low, you can charge the buyer. The buyer only has to pay you a little bit in order for you to get a certain internal rate of return. Like say here now it's like 1%. So the payment here is what matters, and this will change. Essentially, it's a factor of what your IRR desire is, and that's going to be a factor of what your cost was versus what you're selling it for. Yes, I remember this now. This was so complicated to figure out at first. So that's the whole thing we're looking at here. Uh, Now, okay, so this is good. This is good. This is what I wanted. Now we're going to look at some taxes here. We're going to look at some taxes. We don't need this. We got our amortization schedule. And what would be more interesting is to show this over time. Like, let's say I buy and sell 3 different categories of things, and my average margin on thing X, Y, and Z, or thing 1, 2, and 3 is whatever. And you could figure out what kind of rates you charge. You can actually run a whole business off this and figure it out, but that would be way more complex because then I can't just do 500 different amortization schedule tabs. I need to scale it. I do have the logic to where that can be scaled. Um, but the interesting part is adding this whole cost versus sell price because this would be the loan amount, but this is my cost. I need to know that difference. So I believe I've got a pretty cool model I can work on here in the next couple days, which I'll do. Yeah, that'll be some good content, and it'll be a great model. So we'll do that. This is just going to be a basic, single. You can put in your assumptions here, and it's going to show you these key metrics. I'm going to put these over here actually. And seller cash flow is the big number. That's the most important thing. And I do want to put some taxes here, because that's a big benefit of doing these is tax benefits. So any sale in which at least one payment is not due until the following year qualifies as an installment sale for tax purposes. So this is saying like the term has to be greater than 12 months, which all these things are almost always. So such sales must be reported to the IRS using the installment method unless the seller opts out of using this method by filing an election with the IRS. Under the installment method, the payments received by the seller are divided in 2 classes: gain from sale and return of the seller's cost basis in the property. Okay, so taxes need not be paid on the portion of payments representing return of basis. Taxes need not be paid on the portion of payments. Okay, so that's saying up to $250,000 of payments received are not taxed. Now, what about the interest? Tax must be paid on the portion representing the gain. This is paid at capital gains rates, which are usually lower than ordinary income rates, right? The seller, so this is if you sell it all in 1 year, like if you sell your house and you have a gain, I believe that gain is taxed at the nominal tax rate or ordinary income tax. But if you sell it and collect it over multiple years, it's capital gains, maybe. But I think it's different if you hold your home for more than a certain amount of years. Um, okay, anyway, it doesn't matter. The key is we need to figure out the gain from the sale versus return on base costs. So let's look at this. So tax must be paid on a portion representing the gain from the sale. This paid You know, the seller must also pay regular income tax on the interest. Right. So obviously we knew this. So these interest payments are just ordinary income. These principal payments, however, I believe until it reaches 250,000, you don't pay any gains. And then so if we scroll down here, where's 250,000? I'm not paying taxes on this until, about month 269. So I sell this. I don't, and at that point, I then start paying taxes on capital gains tax on each of these, every for whatever year that is, and you pay on, roughly, your gain of 250,000. Okay, this makes complete sense. The following example shows how this works. Okay, Liz sells her house to Derek for 200,000. Derek pays Liz $20,000 down payment and agrees to pay the remainder in equal $20,000 installments. Oh, we could put a down payment function in here. Over the next 9 years, plus 5% interest, Liz pays $80,000 for the house and owns it free and clear. So her total gain is 200,000 minus 80. This means that 6% of each payment represents gain and 40%. Oh, okay. So each individual payment is broken down into this. So when she receives the down payment of 20, she'll have to pay 12,000 of capital gain. She'll have to pay ordinary income tax rate on the 10 of interest. Okay. Okay. Let's see. Do I have a question here? Let's put in the down payment real quick. So we got, uh, so that's going to be like period 0. Hold on. Let's give some more rows here. So original cost, sell price. This is actually going to be financed amount. And then we're going to have sell price. Let's say it's 500,000. Down payment. Let's say, it's what's 20%? 100,000. Let's say it's 80,000. My financed amount is then just going to be this minus this. Okay. So we're financing 420,000. Put this over here. It's kind of hard to see. Oh wait, no, this is okay. Okay, so 15.62% annual IRR. Now the gain is the sell price minus this. So we have a $250,000 gain. Let's do a different number here. I don't want it to be exactly half. Let's say you sell it for 375,000 with a $50,000 down payment. Financing 325,000. Now our gain's 125. Seller cash flow is going to be this plus the down payment receipt. Well, no, the first payment of the year is going to include the down payment. So we'll just add that here. Okay, does that make sense? So 250, so total cash flow is 658, 504. Say 25,000. I just want to understand the numbers here. So, as an investor in this, let's say I put up 250, or the original cost house is 250, sell it for 375, get $25,000 down. Then the remainder of 350 is financed. So the cash flow is different than the tax basis. So we're saying you put out 250 at some point, you get back $25,000 in the first payment plus your regular payments from the buyer. I mean, technically, you could put that 25,000 offset against this cost, I believe, to be more accurate. So we're going to go this plus this. So cash flow is net. I'm trying to think. I mean, if this is an example of, well, it doesn't matter. If we're doing an internal rate of return, that means we're trying to measure cash flow. We're not saying there's any time between the first payment and the actual cost here. So this is fine. We're just going to offset that cost by the down payment. I believe that's the correct way in the most way that makes the most sense. Then we have our amortization here. We have IRR. Now for taxes, here's where it gets very interesting. So we have a total gain of 125,000. So taxes on down payment would be, let's see how they did this. So 200,000. So basis is 120. 60. Now how they get to 60%? Is this 60% just the profit against the total initial cost? Hold on. How do they get to 60%? Yep, okay. So 60% equals the total profit divided by, no, so her total gain is, yeah, divided by the total sales proceeds. So she sells for 200,000. It cost her 80, makes 120. So 60% is 120 over 200, and then 40% would be taxed. So this is divided by the total sale price. So principal payments taxed at 33. Again, so the other 4% is return of this is so, and then return of basis is the inverse of that, obviously. So it's saying every time you get paid, 67% goes towards return of basis, not taxed. And so in the end, this makes sense. Total sales price minus this 125. I should only be taxed on 125. So when I collect all of this principal here, 350, only 33% of it is a gain because my gain's only 125. Now, hold on a second. One, right, that, so total repay. So I collect this amount over the whole time. Only, wait, 116 is the gain. Hold on, hold on, hold on. We're off by something here. Okay, so gain of 125. I'm gonna collect a total of 350 back. Oh, here we go. We got to add in the principal here, plus the down payment. Now, 375. Let's just put all this in accounting here. So now 375 is the total I collect. Of that 375, 33% is tax, which is 125. Okay, perfect. So that makes sense. But so they're breaking it up. We'll say tax tax basis for seller. And so year zero is going to be the down payment times this percentage, and then it'll be every principal payment times this percentage. So in theory, um, this total should add up to 125,000. And let's see. Yep, 125. So there's the tax basis. This is actually going to be a really helpful template. Uh, gain, tax summary. So this of all taxable based on taxable part of principal repayments. And then what do they call the other part? Return of basis? Return of basis part of principal. Okay, so this all makes perfect sense to me. Um, Now the other thing though, so so we got the principal payment plus that of every one. So there's your taxable income for each period. Here's the date. I'll do annual summaries of this as well, but what I want to do is show obviously the interest. We can do that on an annual summary. We can show the interest collected, and that's obviously all taxable. Uh, all interest is taxed as ordinary income. All right. This is great. This is a great tool to use. I really think this IRR calc is very interesting um, from the seller's point of view, and that's all going to be determined based on the gain versus or the cost versus the sale price. The down payment will also affect that, as well as the interest rate in the terms of the loan. And then we have obviously this tax summary, which is also very, very cool logic to show, what's my total gain and how much of that is of the total sale price. Based on that, every principal repayment, this percent is gain, this percent is return of basis. I think that's I guess that's a very fair way to do it. Um, so here, so the seller is going to be taxed at capital gains rate for all this, and then interest rate here is just the ordinary income taxed at ordinary income levels. All right, very good. I'll do, so this is a model. I'll do an annual summary tomorrow, and we'll finish this up. And then maybe next week I'll look at scaling this out into an actual financial model 5 or 10 years, where this is done repeatedly over, every month a certain amount of this activity happens, and then we can aggregate that to show like a financial model where you've got seller financing. I think the logic is very interesting. And actually, I always wanted to do that since I learned about it, is because I've got the general. So this general lending model here for 75 bucks. This thing scales out 3 different loan types. So we'd mainly just be looking at this principal plus interest, but we want to show the difference of the actual the cost is what would be considered, cash requirement, your cost of whatever you're selling. But then the loan amount's financed, so there'd have to be a difference. There'd have to be a lot of adjustments made to this model to make it make sense. But I believe I can take what's happening here and modify that model pretty. So I think I might actually modify this model to fit rather than do it from scratch, because I think I can apply these concepts at a high level. So we'll look into that. We'll look into that for sure. So this seller financing model, I'm going to include it in the lending bundle. First of all, this is only going to be this template here that I just built is 45 bucks. I'll add it to here at no extra increase to this price. I'm also going to add it to the real estate model, and then when I build out the full version, I'll probably charge $75 for that, and it's going to be, I'll probably include it in the real estate bundle as well as the industry specific bundle and the lend money bundle. And I don't know, I might have to raise this price up to 125 if I do that, because then the values, well, we'll see, because it'll be 75. Maybe we could keep it 99. Okay. Yeah, I love doing new logic like this. I love when it all comes together. So we'll see what we do here. Remember, you can check out all models at smarthelping.com. You can buy everything I've ever built for $999. I've got hundreds of templates, all unique, all very valuable logic for any finance professional, accounting people, HR departments. A lot of people could benefit from the tools I've got here. So, that's all I got for you. Looks like we had some likes here, had a couple viewers. That's great. Good to see. We'll be back tomorrow. Like I said, I'm going to do some annual summary, and then I might pull up the lending model and see what kind of adjustments I need to make to allow you to build a business that scales out by doing seller financing, to see aggregate effects of doing this over time, which I think that would be very interesting. Okay.